A few days ago, the Congressional Budget Office released its estimates for the size of the U.S. government's annual budget deficits for the next 10 years. The CBO expects budget deficits of $1.5 trillion this year, $1.8 trillion next year, and $1.7 trillion the year after that. As a percentage of GDP, these deficits would amount to 5.3%, 6.1%, and 5.5% respectively, among the highest in the nation's history. I was recently asked, will government borrowing to fund such large deficits drain liquidity from the financial markets and cause market-determined interest rates, such as the yield on 10-year Treasury bonds, to move sharply higher in the near term? And isn't this particularly a risk since liquidity already appears to be drying up, given that the amount of funds liquidity held in reverse repurchase agreements at the Fed has already shrunk very sharply, from a peak of $2.4 trillion in September 2022 to $600 billion now. Many people share this concern. They worry that government borrowing will cause bond yields to surge, and that surging bond yields will cause stock prices and the economy to suffer. This video will show that those concerns are misplaced. Government borrowing does not drain liquidity from the financial markets, so long as the government spends the money that it borrows. Government borrowing does drain liquidity, but government spending reinjects that liquidity back into the financial markets. In the current environment, after so many rounds of quantitative easing between 2008 and 2022, there is enormous excess liquidity. There is so much excess liquidity that the Fed is being forced to pay interest on bank reserves and reverse repurchase agreements to prevent interest rates from falling back much closer to 0%, where they were before the Fed began paying interest on those funds in March 2022. The Fed controls the federal funds rate by paying interest on bank reserves and reverse repurchase agreements, so that the banks and money market funds that own those funds won't lend the money to anyone at a rate of interest below what the Fed will pay them. The Fed is currently paying 5.4% on bank reserves of $3.4 trillion and 5.3% on reverse repurchase agreements of $600 billion in order to make interest rates high. This is how the Fed holds the federal funds rate in a range between 5.25% and 5.5% at this time. The Fed has increased the interest it pays on bank reserves and reverse repos from close to 0% in March 2022 to nearly 5.5% now, to cause the economy to weaken in order to drive down inflation. Now that inflation is slowing rapidly, the Fed is likely to begin lowering the amount of interest it pays on these funds, thereby causing the federal funds rate to fall. The Fed expects to reduce the amount of interest it pays on these funds by 75 basis points by year end, while market participants expect a reduction of up to 150 basis points. As the Fed reduces the interest it pays on these funds, the market-determined interest rates throughout the economy will also fall, because the Fed will no longer be holding them up at as high a level as it is now. This video will provide all the details. It will also explain that it is quantitative tightening that is draining liquidity from the financial markets, not the government's budget deficits. Therefore, it's QT that investors need to worry about.